Welcome to the basics of strategic tax planning. The three components are tax bracket optimization, tax deferral, and leverage depreciation. When we talk about tax bracket optimization, what we're trying to do is get the taxpayer in the lowest possible tax bracket. For example, if you're in 37% tax bracket, what do we need to do to get you into the 35%, 35 to 32, 32 to 24, and so on and so forth. When we take a look at Roth IRA contributions and conversions, I believe the optimal tax bracket is 12%. That means a married couple can make up to $96,951 taxable income annually. They're going to pay 12% on the majority of that money, but once it's converted, they'll never pay taxes again. Once you start into the 22% tax bracket, I believe that 401k salary deferrals are a great way to optimize your bracket. And once you hit 32%, leverage depreciation can substantially help reduce your taxes. Regarding tax deferral, pre-retirement, most people are going to use salary deferrals and employer contributions in IRAs, 401ks, defined benefit plans to help save for retirement and get tax deferral along the way. Once they're retired, however, the opposite is true. If you're going to convert your IRA into a Roth IRA, you have to make sure you're getting tax deferral over time. Otherwise, you may find yourself in a much higher tax bracket. The number one reason that most Roth conversions fail, or at least don't make sense for most people, is the fact that we've got progressive tax brackets. That means the more you convert to an IRA into a Roth IRA, the higher the taxes are. And if you're in the 22% tax bracket, you'd be surprised how quickly you'll end up in the 32, 35, and 37% brackets. So systematic Roth conversions is the solution that allows us to take control of our taxes. And the methodology is this. We convert up to the Section 461 limit annually, and then we offset the taxes or the income derived from the conversion via leverage depreciation. Remember, an IRA is an IOU to the IRS, but leverage depreciation can make that IOU zero. Speaking of leverage depreciation, depreciation itself is just a wear and tear allowance. 2025 moving forward, we're back to 100% accelerated depreciation as an option. But depreciation itself just helps us write off the wear and tear of a business asset. The most commonly depreciated assets are vehicles, equipment, and real estate. The useful life of the asset is what the depreciation will be based on. So if you have software for business, you can depreciate that over 3 years. If you buy a vehicle for your business, you can do that over 5 years. Residential real estate, for example, is 27.5 years. However, the IRS doesn't care if you pay cash or you finance it. So in other words, if you could buy a $50,000 vehicle cash for your business, that's great. You'll be able to write off $50,000. But if you put zero down, 0% financing, you're still going to be able to write off the same $50,000. And the larger the asset, the more critical that leverage becomes. Section 461 is the limitation on business losses. So especially if we're trying to focus on systematic Roth conversions, most retirees don't have business income. So therefore, we're limited as to how much we can convert by that Section 461 limit, which is $626,000 for married joint taxpayers and $313,000 for single taxpayers. This is important because the tax losses associated with depreciation are limited as to how much they're going to be able to offset conversion taxes. One way to enjoy the benefits of depreciation is to participate materially. And that definition is You participate more than 100 hours annually, and no one else does more than you do. And the easiest way to facilitate that in business is to have a single member LLC, no employees, and spend 2 hours a week working in or on the business. If no one does more than you do, you spend at least 100 hours a year on the business, then the depreciation losses can offset the conversions up to the limits talked about earlier. However, if you don't meet the material participation standards, then it's a passive activity loss and it's not going to help you at all. So the easiest example is Turo. It's kind of like the Airbnb of cars, where you can go out and acquire a vehicle, let's say a $30,000 SUV, zero down, whatever the payments are a month, $500 a month. You spend 2 hours a week leasing it out via Turo, and the income that's coming in should meet or exceed those expenses. But now you've acquired a $30,000 asset on credit. You're going to be able to depreciate that in its entirety and thus either A, save $10,000 in tax savings, or B, offset $30,000 of IRA to Roth conversions. Now, obviously, if you have a $1 million portfolio, a $30,000 depreciation allowance isn't going to help you. However, the fundamental aspect of it remains true. Okay. So, quick recap: strategic tax planning is based on tax bracket optimization, tax deferral, and leverage depreciation. We just need to make sure that we're cognizant of excess business loss limitations and material participation when we utilize leverage depreciation strategies. Thanks for listening to the basics of strategic tax planning.